Good morning, it's Jeff Christian, CPM Group. It's the 3rd of March. Tomorrow, CPM Group is going to be hosting a webinar on silver, and we'll be releasing a report, I would say short, but it's gotten longer and longer, on silver, a sort of a preview of our silver yearbook, which will come out in the middle of May this year. There's a lot of interest in silver right now. There's a lot of misperceptions circulating in the market. Two charts here. One is the top chart is actually from 1980 to 2001 or actually December of last year. Our intermediate term buy and sell recommendations. These are published recommendations. You can see the first one was in December of 1980, and I said, oh, sell this stuff. In the middle of 1982, I issued a buy recommendation. These are recommendations for our investors who are what we call intermediate term investors. So they have a 2 to 3 year time horizon. We told them to sell in January of 1983, told them to buy in 1985, et cetera, et cetera. You could see that from 1980 to 2000, we were back and forth in the market. And in fact, I think the number is about 65, 68% of the time, we were telling people don't buy silver, buy gold. I mean, don't buy silver, sell, either go neutral, or if you know how to do it, short silver. In late 2000, we issued a buy recommendation, and we kept that until January. Well, actually, I'm not quite sure exactly when it was. I think it was January. By January of 2012, we issued a report to say that said basically get out of commodities because we're entering a 3 to 5 year downward cyclical move within a secular bull market. And then we issued a buy recommendation around 2019, 2020 in silver, and we have that in place. And this price chart's a little bit out of date because the price has risen since that time. We put that in there because our price projections are predicated on a macroeconomic top-down and a microeconomic review of the silver market, down to the mine level, how much mine production is going to be produced, secondary recovery from scrap, fabrication by major industry and major country, investment demand, and inventories. Those are the fundamentals that we look at in determining what we think the price is going to do over the next year, over the next 3 years, and over the next 10 years. And we have a pretty good track record, as you can see here, on our intermediate term price projections. And it's predicated on the statistics that we develop, the estimates that we develop on the fundamentals of the silver market. The fact that we have a pretty good track record suggests or provides evidence that perhaps we're pretty accurate on our supply and demand analysis. Now, tomorrow's webinar will deal with what we like to deal with, the real silver market, total supply, fabrication demand, investment demand, and inventories. Given everything that's going on, we will also wind up talking about some other crazy things. We will talk about how the reality is that in London, you have record amounts of silver in inventories. And 450 million ounces of that is in fact unallocated. We'll talk about how it wasn't the lack of silver that caused issues with the SLV during the attempted squeeze. It was the back office having to clear 60 million ounces worth of share trades in a day when it's geared up to trade an average or clear an average of 2 million a day. So you just didn't have the capacity to do the paperwork. And that was the static or friction that caused those issues in the first week of February. We'll talk a little bit about that. We'll talk about how it's not the relationship between open interest and inventories that matters on COMEX. So a lot of people look at it and think, oh my God, there's 700 million ounces of open interest, and there's only 600 million ounces of inventories. If everybody took delivery, they could squeeze this market. What's important are the deliveries and the relationship between inventories and deliveries. So one of the charts that we'll look at tomorrow, one of the charts that's in the webinar, one of the charts that's in the report that comes out with the webinar, the free report that comes out with the report or webinar, is looking at open interest versus deliveries, open interest versus inventories, And the important one, deliveries versus inventories. And you can see here, as we all know, 99+% of the open interest doesn't get delivered. These are people who are not seeking to take delivery via the COMEX. These are people who are seeking price exposure, either as hedgers or investors. They don't want the physical silver. They want exposure to rising and falling silver prices. And that's why they're in the futures market as opposed to the physical market. And what you need to look at is that 1% of open interest or less that gets delivered. And when you compare that, that's these little pale blue lines at the bottom of this chart. It pales in comparison to inventories. The silver market, COMEX, has never had a higher ratio of inventories relative to deliveries. It is well supplied, as is the London market. So we'll talk about some of those things. Because there's a lot of strange views being circulated, we'll probably also try to touch on arguments and discussions. Oh, the silver market's clearly manipulated. JP Morgan has pled guilty of manipulation. JP Morgan has reached an agreement that it hasn't been supervising its trading desks across assets. And the bulk of the complaints against it were in treasury securities, other debt securities, and equities, and precious metals. And it was a lack of supervision and a pervasive environment that contributed and allowed traders to spoof the market and diddle around on a daily basis. No grand conspiracy to suppress the price, no bigger conspiracy to suppress the price, just really sloppy management and oversight of a bunch of Wall Street pros. Barclays was one of the first companies to be fined for somebody manipulating the gold option market. When they did that, the crazies came out and said, oh, well, you see, Barclays, they've been manipulating the market to suppress the price. And if you read the actual case work, Barclays' own gold traders didn't know what this option salesperson was doing. So was there no conspiracy among banks? There wasn't even a conspiracy within Barclays. The trading desk didn't know what this salesperson was doing. And that's the kind of manipulation that we're finding. And that's the kind of manipulation that has occurred ever since exchanges were created hundreds of years ago. And that's the kind of manipulation that occurs across markets. Now, I am famous for saying that all of these conspiracy theories are very expensive distractions, and they are. Take a look at what happened in February. You know, the price of silver was rising for a variety of reasons. And there were people saying, well, you know, the conspiracy is going to break. Same people who have been saying that there's this massive short position that's going to break since the late 1980s. And as a result, investors who believe this stuff, when they see the price go from $25 to $30, they think it's going to $200. Wiser heads and people who actually understand the futures market and the broader physical market say, no, 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 it's going back to 26 or 27. Take your profits at 30, buy back at 26. You just made several dollars on your silver. You reduced your you lowered your effective acquisition price. And it's a very costly distraction. And it's very painful for people who believe the nonsense that circulates in these markets. But we'll talk about that more tomorrow and probably in the future, because one thing you can say about conspiracy theorists, they tend not to go away. And these conspiracies that silver and gold have been manipulated, they're about 5,000 years old. I'll see you tomorrow. Thank you.